to the Stockout. The Stockout is your show at FreightWaves for all things related to the CPG industry. I'm your host, Mike Baudendistel. I'm the head of Intermodal Solutions here at FreightWaves. Do a lot with data and also do a lot on the media side here, including being the community leader of the CPG community. And what we're going to do today on the Stockout is talk a little bit about the CPG earnings that have reported so far. And I think it's safe to say that the CPG earnings season is off to a strong start, maybe in contrast to what we're seeing from some of the freight carriers. So good news for shippers, maybe not so great for carriers. Go through a little bit, talk a little bit about Procter Gamble and how those relate to some of the big CPG trends I'm seeing in the marketplace, not just for that company in particular, but also CPG overall. And then I'll give a little bit of an overview of what's been on the site that's I think should be interesting for most CPG companies, and talk a little bit about the freight market and what we're seeing there. But before I do those things, if anyone has not already signed up for the CPG newsletter, the Stockout, easy to do so. Just go to www.freightwaves.com/the Stockout. I try to get one of these out every week on Wednesday. This week, I think I'll go through, what we learn tomorrow from Nestle, the world's biggest food and beverage company, set to report earnings. They do tend to do a pretty good job of, telling us what's going on in the marketplace. They do tend to beat either beat the consensus or at least do a little bit better than the industry overall, because they're so diversified and seem to have really redone their product portfolio in the direction of having products that are higher margin, higher velocity, faster growth areas, things like health products, pet foods, and some of those areas that are faster growing within the CPG industry. So with that, talk about our first topic today, which CPG earnings are off to a strong start. Some of the trends that I've been talking about in the CPG industry have been, the margin improvement. I think, as we go through the first quarter earnings, a lot of these companies are going to report margin improvement for the first time in a couple of years, starting to see that. The elasticities are continuing to be muted. That's sort of trend number two, where volume hasn't fallen off too much, even though pricing has been up sharply, a couple of years in a row. Still seeing price increases. The third sort of trend here is fewer supply chain issues within CPG, which I think is good news for the CPG companies on multiple fronts. I'll talk about that. And then I think management is starting to shoot down some of this bear thesis about the over promotion of certain products. The thesis is out there that the CPG companies are going to basically give away any margin improvement because they're going to have promotions, things like buy one, get one free deals that erode away any impact of pricing. And then if there's a fifth trend, I think it's really sort of the divergent fortunes around the world, as far as the consumer being in very different places in the U.S. versus Europe versus China and elsewhere. I'll talk a little bit about that too. So with that, I'll talk a little bit about what we heard last week on Friday from Procter Gamble. I have a stock chart here that shows Procter Gamble's performed rather well the last couple of years. The black line there is Procter & Gamble's share price, and in blue on the left axis is the S&P 500. So it's really outperformed the market last 2 years. Really, there's sort of kind of this shift to quality blue chip names last year. I think a lot of the CPG companies benefited from that. And then you see at the very right part of that screen, it bounced up. Stock was up about 3.5% on Friday, and really sort of thought the big variance there was the company's volume held up better than expected. I'll talk a little bit about that, but first, maybe this company's margins, which is really sort of the big thing that I think most CPG management teams are focused on, is getting their margins back to where they were before the pandemic. When the pandemic hit, strong demand for CPGs, but that actually added a lot of costs for things like contract manufacturing, for issues like not having enough of the ingredients, so that caused a lot of surge demand, and really then the inflation hit a couple of years in a row, and all those things contributed to margin contraction. And with Procter & Gamble in the last week saw their most recently reported quarter, which I guess is their fiscal third quarter, their gross margin improved 150 basis points year over year. operating margin up 40 basis points. So it was the first time in a couple of years they were able to report margin improvement. We saw something similar with ConAgra when they reported a couple weeks ago. They, ConAgra got their margins almost back to where it was in the pre-pandemic level. So most CPGs still below where they were before the pandemic, but getting those margins much closer. And from what we've heard on commodities, the CPG companies are starting to call their commodities and their cost inputs a mixed bag, which that mixed bag phrase is really a departure and a welcome departure from what we've heard really the last 2 years, which CPG's costs had been rising completely across the board. I mean, kind of like just how costs throughout the economy are rising across the board. But now CPGs are starting to call out certain commodities that have come down. I mean, certainly we see that a lot of that in the publicly traded commodities, things like corn, wheat, soybeans, but then you also see that in some of these other commodities that a company like Procter Gamble uses heavily in its products, things like pulp and resins that go into some of the absorbent materials. They also called out stability in raw materials and packaging costs, which is a big part of CPG companies' costs. And so, I think all those things are going to contribute to not just margin stability, but margin improvement. You sort of look at Procter & Gamble's, gross margins, 48% and change, still below the 50% and change it was before the pandemic. So still a little ways to go. But I think when you bring up sort of the chart on the CPI versus the PPI, I think that's a very similar pattern to what you see in the consumer packaged goods industry, where the white line, which is the consumer prices you see on shelves, those are in white for the industry overall, and then in blue are the prices that the producers and manufacturers pay. And a very similar pattern we see in CPG, where the spread really narrowed during the pandemic in 2020, 2021, and 2022. And that caused a lot of margin contraction. And now it's starting to go the other way. You look at the latest data from the CPI, consumer prices up 5% overall in March, but that food at home was up 8.5% in March. And when you compare that to the producers' price index, up 2.7%, so about half of what the CPI was up, and then the finished foods up 6.7%. So sort of the implication is, if you just look at what's happening with retail prices, what's happening with manufactured prices, that spread is widening by about, let's say, 180 basis points in the most recent month, if you just look at the government data. So it does imply that most of these companies are going to be able to get margins that are improved. It's really sort of the CPG company's top priority. The other sort of high priority is keeping elasticities manageable. And I do think that the data that we're seeing from CPG companies that are reporting, is that the elasticities have been well behaved. So Procter & Gamble last week, as an example, took prices up 10% overall. Volumes declined 3%. That's a pretty healthy elasticity. And what's even more interesting than just that number is if you back out Russia was about 1 point of that volume decline. And so it would have been more like a 2% drop. And then they said in the past month, the volume was only down 70 basis points, excluding Russia. They are getting some benefit from China coming back online as the Chinese lockdowns really sort of subside. So I think that's a lot of good news in terms of the companies aren't giving back as much volume as maybe they would have expected based on history. And I think it shows that the consumer is maybe not in as bad of a situation as some people expect, or maybe just the CPGs are kind of the last thing people cut back on. They're cutting back on more on the big ticket type items. So you saw something similar with Coca-Cola when they reported. It was just this morning, Monday morning, and their case shipments are up 3%, and that's with pricing that was higher as well. So they really didn't see much elasticity at all, particularly in North America, which is also maybe a point to make, is that in North America, really seeing elasticity that's below most of the other countries. When you look at the UK, their inflation is more like 10% versus the US 5% in the most recent month. So you're seeing more pricing pressure there. So the CPGs that are really multinational in nature, maybe seeing a little bit greater change in volume. So I'd keep that in mind as well. Trend number three is fewer supply chain issues are really being felt across the CPG industry. So great news for CPG companies, and it was really sort of been a huge problem throughout the pandemic. You heard things like General Mills saying that they didn't know when the truck was going to show up. You heard Kraft Heinz say that on any given day there's some ingredient or some packaging material they don't have. Seeing a lot fewer of those types of issues, which has actually made it a little bit harder to find topics to write about for the Stock Out newsletter. But I think in general, these are good things. When they're talking less about their supply chains, I think it means that there are fewer problems with the CPG supply chains. And alongside that, companies are talking about freight costs as no longer, being a headwind, which I think is kind of an interesting way to put that. Not necessarily calling out freight costs as being a tailwind yet. I do have a chart on dry van contract rates, and so you see the dry van contract rates on average. These are rates from a transaction processor in white, and you see those rates come down from the first quarter of 2022. They average of $2.89, so they were down 12% in the quarter to about $2.54. Still well above spot rates adjusted for fuel, which are in orange. The white line is contract rates, not including fuel surcharge. And so you sort of put that in the context of, well, what does that mean for a CPG company? Well, transportation logistics costs tend to be about 8 or 9% of their cost of sales, and so a 12% drop is maybe equates to a 1% decline in the cost of sales, which is significant, but not as impactful as, let's say, if a key ingredient really declines in price. And I think that's why you're seeing CPG companies prioritize, getting those products on shelves into the retailer's warehouses, having those on time and in full, rather than having a little bit lower price. And that's part of the reason why the van contract rates are holding up better than maybe you would have expected, given how low the spot rates there. You see the spot rates in orange at $1.76. Those are really, depressed, and usually expect them to pull on the contract rates maybe a little bit more. That's related to, I think, maybe the most interesting question from last week's State of Freight event with our CEO, Craig Fuller, our head of market intelligence, Zach Strickland, and then we had a former analyst there, Adam Josephson. And sort of the question was from one of the audience members is, if you're a shipper, should you just try to get the lowest price right now in the spot market with spot rates so much below contract rates? And there's really a difference of opinion where Craig basically said, go for it. And Zach was a little bit more cautious. From my perspective, following some of these CPG companies, I would say it sort of depends what type of CPG you're talking about. If you're maybe a smaller one that's not necessarily the big fish, I'd say go for it and try to get the lowest rates in the spot market. But if you're one of the bigger ones that knows they're going to need lots of capacity, I think you sort of take the approach, tell your carriers, we're going to take care of you right now, but in exchange, when the market turns around, and it will turn around as capacity exits, we expect our carriers to take care of us and just really try to be that preferred, shipper. I don't think that approach maybe works for smaller shippers, but for the big, national and multinational CPGs that need lots and lots of capacity all the time, that have a base level of demand, that primarily work in the contract market. That is sort of my sense is that's the approach to use is really try to be a preferred carrier. Don't beat up be a preferred shipper. Don't try to beat up the carriers too heavily. Another trend we're seeing in CPG industry is this sort of bear thesis that's out there on the over promotion of products. And really what this means is that during that past couple of years, companies have raised prices a tremendous amount, and they haven't just done that with the list prices. They've also done that with having fewer promotions, which buy one get one free type deals. Having less of those deals means that they can sort of raise prices without raising prices. And now that there's maybe consumers are a little bit more sensitive to price, and with commodity prices coming down, there's a bearish thesis among some investors that these companies are going to trip over each other to do more promotions in order for the sake of volume holding up. I think maybe that thesis is a little bit overdone. I mean, you are seeing some of that certainly. Coca-Cola was talking about earlier today about how they're going to do that in certain targeted markets, and clearly Procter Gamble has increased how many promotions they're having, but I don't get the sense that they're going to give away all the margin improvement there. And it's really going to be targeted to areas where the companies feel like there's a lot of sensitivity to price, or something that caters to a certain demographic that's really likely to shift to a private label type brand. But it is certainly something to keep an eye on, and something on top of everyone's mind. So with that as a little bit of an overview of what's happening in the CPG industry to the companies themselves, I'll talk a little bit about what's new with Sonar, which to me I think is something pretty significant. Contract rates are now available in Market Dashboard. I have some art on a article that FreightWaves staff, someone who didn't want to be named, I guess, published this. But this is pretty significant, because we have this Market Dashboard application in Sonar, and it's very user friendly. All you do is put in the origin and the destination of the transportation lane. And previously, we just had in there the spot rates from the track, which is the trusted rate consortium. So with track, what that means is it's a consortium of third-party logistics companies giving us the rates that they're paying to carriers every day, basically the buy rates. And then a lot of companies, including a lot of CPGs, sort of said, well, what would really help us is the contract rates, because we're primarily in the contract market, and we want to compare those to the spot market in order to be surgical about both. When should you use the spot market if you're in a situation like this? And like you see on this chart, Seattle to Chicago, $1.44 in the spot market, $2.06 in the contract market. So really a big discount to move on the spot market. Conversely, when the market's tight, it helps shippers to quantify risk, and sort of it's to say, well, what's sort of the risk that if your load doesn't get covered in the contract market, what would you have to pay on the spot market, which is normally something much higher if we were in a tighter freight market. So I think it's something that CPG companies will care about. It sort of streamlines that process of getting at contract rates. I mean, we previously had those in Sonar, strictly in the what we call the CSI tool, supply chain intelligence. But I think this makes it just a more user-friendly product for CPG companies. So I would encourage everyone to go check that out. Move on to the next topic here, which is intermodal growth called into question. I think there's, this has been a topic that's been on our mind for a long period of time. When I first joined FreightWaves in 2019, one of the first things I did was write an article about whether intermodal is still a growth area. And that was almost, let's call it 4 years ago now. And it's still, a question that's top of people's mind. This is Zach Strickland's take on this. He published this over the weekend. I would try to get in the habit of reading his Chart of the Week article, which is really sort of well curated, very well worth your time. Sort of tends to pick out one Sonar chart that really stands out. And Zach calls into question some of the reasons why you might think that intermodal is not the growth area that it has been historically. Some of these are things we've talked about in the past, like the East Coast ports gaining share from the West Coast ports. He also brings up the China situation, with more shippers trying to lessen their exposure to China in case the geopolitical situations really come to a head. In China, you've seen some big companies try to get out of China completely, and then if you move some of that production to, let's say, elsewhere in Asia, let's say Southeast Asia, all of a sudden it makes much more sense to use the Suez Canal to get it in through the East Coast. So that's one reason that could make it unlikely that intermodal is sort of the growth area it historically has been. And then another reason is just the service levels, not at a place where most shippers, including most CPG companies, are really satisfied with. The railroads blame the lack of worker availability the past a couple years, on that. But I think there's maybe more goes into that as well. Things like, cost for demurrage and detention that the shippers were not happy with. Fortunately, a lot of those charges have come down. Do have an interesting chart. It's a tree map on outbound domestic container volumes in some of the densest lanes. If we can put that tree map up on the screen, there it is. So one of the interesting data sets in FreightWaves Sonar on the intermodal side is volume, and we can segment this out any way, which way you want to segment it out. And here, a lot of times when I talk about the market, I say put the densest lanes on a screen and then talk about the lanes. And the pattern that really stands out now is these domestic containerized volumes down double digits, but it really is mixed by lane. But the densest lanes are the ones that are down the most, and those lanes fit into the category of the outbound LA lane. So LA to Chicago, which is the densest lane on BNSF that JB Hunt uses heavily, down 8.4% in the last week. LA to Dallas down 28%. LA to Atlanta down 16%. So it really shouldn't have surprised anyone when JB Hunt came out in its first quarter earnings and say, well, the transcon volumes are down, but the East Coast volumes are up. So really sort of a change in mix there to a shorter length of haul. Some of those deeply backhaul lanes and intermodal are actually up, year over year. Lanes like Chicago to LA, Dallas to LA, up 7% and 8% respectively. So a little bit more, balance in the network. And, right now it does make it possible for shippers to find intermodal capacity sort of outside of the densest domestic intermodal lanes. So there is an opportunity to convert from truckloads to intermodal based on capacity that's available. JB Hunt had a really good quote that they said that they have about 15 to 20% excess capacity. They said that when they reported their first quarter, they said they have all the resources in place to move incremental volume. And the one constraint is imports coming off the docks at the ports of LA and Long Beach, which would then be transloaded and put into domestic containers that they would then move on the BNSF. So too few of those international containers. And the other thing that's going into that is there's a looseness in the availability of international containers. So mostly those 40-foot containers that go across oceans, there's plenty of those now. And so those containers are largely, to at least the larger extent, being sent intact to inland destinations. And that makes causes there to be less domestic intermodal loads and more capacity available for domestic intermodal shippers. So those are a few of the things that are happening in the domestic intermodal industry. Plenty of capacity there, and you could even say, well, a third thing that's going on there is the truckload market is very loose, and in particular, those West Coast origins where you have tender rejection rates really in the low single digits. They've been the lowest that we've seen those tender rejection rates. So something that's like kind of a traditional intermodal lane, something like LA to Dallas, about 1,500 miles. Normally it would be an intermodal load. Really the highway is very competitive in some of these longer, lengths of haul. You have one data set in Sonar that compares the intermodal rates versus the truckload rates on the same lane. So we look at the same 5-digit origin, 5-digit destination pairs, include fuel for both of those. And right now that intermodal savings is only about 9% and change overall. And if you look at just the ones that are just the loads that are over 1,200 miles, there it is. Yeah, so it's that white line, 9.36% is the intermodal savings rate. So it's not very much. And then you look at the ones that are just over 1,200 miles, which would include something like an LA to Dallas, about 14% difference. And you have to sort of think, well, maybe that's not enough to entice a shipper to use rail intermodal, especially considering the prioritization that a shipper like a big CPG company places on getting those products on time and in full it seems like they do not want to lose market share to not having those products at the retailer, even if they end up paying a little bit more in transportation costs. It seems like service is a higher priority than cost. That's not good for rail intermodal unless the intermodal service can be improved to be truck-like, which is kind of the objective in intermodal service, where you can't tell the difference. The shipper can't tell the difference between intermodal and truckload. So those are all trends we'll be watching. I'll try to get out Stack Out newsletter on Wednesday. If anyone needs anything from me, feel free to send me an email at mbaudendistel@freightwaves.com. Hope everyone has a good day.